Our next speaker is Tony Cousins, and Tony is the CIO and CEO of Pyrford International, and he's also one of the 4 PMs that is managing the Net Group Investments Global Cautious Fund. Now, during these uncertain times, Tony's presentation title will be talking about how Pyrford's a proven ability to stick to their process and the fact that they've been able to deliver to their clients' needs over the past 28 years. Now, joining us now is Tony. Tony, thank you so much for your time. I know that you've got a presentation prepared for us, so I won't take up any much more of your time. I'll be handing over to you, and hopefully we'll have some time to get into a question or two afterwards.
Okay, great. Thanks, Tumi. Good morning, everybody. I know time's short today, so I'll jump straight on to the first slide here, talking about the first quarter. Obviously, a very tough quarter for global capital markets, both bonds and equities down, bonds slightly worse. Falling sort of mid to high single digits, and if you were the long end of the curve, you were getting into double-digit losses. Equities also had a tough quarter, falling in global terms by around 5% in US dollars. Our process, and that's the title of the slide, Trusting Your Process, is very much about trying to preserve capital when risk is high, and minimizing exposure to risk when there's a lot of downside opportunity. And I'm pleased to say that this worked well in terms of being defensive during the quarter. We were not able to avoid a negative return, but it was only minus 0.76, so less than 1% over the quarter. Some highlights there, both in non-US equities and US equities, we were able to outperform the declines in the indices by sticking to our process of investing in high quality and well-valued equities. Very pleased to say that non-US equities actually produced a positive return in a market that was down 5%. We produced plus 3.5%, and again, that is by sticking to defensive, high quality, well-valued equities in the right parts of the world. So the equity performance contribution was actually marginally positive. In terms of bonds, where there was real carnage, again, we were able to outperform bond indices. Here we did this by sticking very much to the short end of the curve, and I'll come on to talk about that when we look at the current state of bond yields, because we think there's more problems to come there. Currency hedging, this detracted from performance because the one currency that actually went up against the US dollar was the Australian dollar, driven by commodity prices, largely in the short term, and obviously having that currency hedged produced a negative result, which was essentially 2/3 of the negative result of the total portfolio. We do value currencies on the basis of purchasing power parity, and we do believe the Aussie dollar remains very expensive. So we do not intend to change that position. So that's a review of what happened in the first quarter. As I was just talking about currencies, let's just have a look at what has happened over 2021 and the first quarter of 2022. What we've seen is a significant strength from the US dollar. Obviously, when missiles and bombs start flying, as they did in the first quarter in Ukraine, there's quite often a rush back to the US dollar. And that is what we've seen. But I think probably the longer term influence here is that the Fed is going to be raising rates quite aggressively. They've made that abundantly clear. They are behind the curve, and they are likely to be more aggressive than the ECB and certainly the Bank of Japan, and that has led to dollar outperformance. So we've seen some very significant declines in 2021 for the Japanese yen and the euro. and these continued again in the first quarter, with the yen particularly weak. Pleased to say that within this global cautious fund, the exposure to the yen is very low. It's only about 1%. And similarly, the exposure to the euro is only about 1%. So we have been able to avoid the worst of the losses occasioned by Forex. So let's talk about what's happening, I think, in the world. Some of you may have seen this slide before. This is about money printing, and just looking at how extraordinary the last 2 years have been. Let's not forget that before the global financial crisis, central banks didn't do this. It was seen as something that only countries like Argentina or Zimbabwe did. But this new tool was discovered in the toolbox post the financial crisis, and banks began to print money and expand their balance sheets. In sort of retrospect, it looks like they were actually fairly controlled for the first 12 years of this program. They added about $10 trillion to their balance sheets. But then COVID came along and this money printing absolutely exploded. So between 2008 and 2020, they added $10 trillion. And then in the last 2 years, they added another $10 trillion. And this has caused some immense distortions in capital markets in terms of valuation. And it has, we believe, contributed to some of the inflationary pressures that central banks are so worried about now. Let's just look at some of the valuation issues. We put different valuation charts up before. This is Warren Buffett's favorite measure of valuation, which is market capitalization to GDP in the US. And we can see just how stretched this is. This is 3 standard deviations away from its long-term average, which indicates that the US market is extremely overvalued. And it's been driven by one particular part of the market, which is now starting to suffer, and that is the tech sector, the FANGs as they're often known. Now, bubbles in growth stocks have been seen before. This is a long-term chart going back to the early 70s. At the beginning of the 70s is this concept, for those of us old enough to remember it, called the Nifty 50. These were companies like Polaroid and Kodak, etc., which were driven to quite absurd valuations, and that bubble burst in the late 70s. A lot more of you will remember the dot-com boom of the late 90s, again driven to excessive valuations, and again in the first 3 years of the 2000s, this burst as well. This time it's been even more pronounced in terms of the outperformance of global of growth. Sorry, these are the FANGs, the Facebooks, the Amazons, the Apples, the Microsofts, the Googles of this world. Now, we're not saying that these are bad companies. Indeed, many of them are very fine companies. It's just the valuation is wrong. And this has been driven by excessively lax monetary policy, very, very low interest rates. These are what you would term long duration equities. A lot of them don't make a huge amount of money right now, but they promise the big pot of gold at the end of the rainbow. And if you discount that pot of gold back at a very, very low discount rate, then you can justify such excessive valuations. Well, that discount rate is going up as bond yields are rising and central banks are tightening. And this is a very, very vulnerable part of the market. Some of them have already started to crack. You may have seen Netflix, a real darling of the growth sector, fell 35% yesterday. It's now down 67% in less than 6 months. So what goes up will come down when those conditions change. The issue here clearly is inflation. and central banks have admitted that they are very, very much behind the curve, and certainly the largest of them all, the Fed, is going to have to tighten aggressively. They've only just started. Please listen to what Jerome Powell says, because they mean it, and they are going to be tightening here, and these are going to provide very difficult conditions, we think, for capital markets in terms of preserving capital. Clearly, central banks are behind the curve. For too long, what is now known as team transitory, those people who believe that inflation would just be transitory during the COVID recovery, prevailed, and they didn't tighten. That view is now very discredited as higher and higher prints have come in for inflation. The one thing that they held on to here was that commodities and supply chain disruptions would indeed prove transitory, and as those prices fell back, they would have a depressing effect on inflation. And then Russia invaded Ukraine. And even those hopes were blown out of the water, where we saw big increases in commodity prices, particularly energy, and this was coupled by a doubling down by China on the zero COVID policy, and leading to further disruption in supply chains. So inflation now has continued to print higher, and in the US you will have seen it's actually surpassed 8%. So what we're faced with are inflationary conditions which haven't been seen for decades, and central banks are clearly going to have to act to bring this under control. What does the bond market think of this? Well, the bond market, I think, is behind the curve as well. Too many people believed in this transitory story for too long. Bond yields were driven by this huge amount of money printing and asset purchases by central banks to absurd yields. We think we saw a peak of $18 trillion of government bonds with negative nominal yields. People thought it was a good idea to pay governments to borrow from them, and in hindsight we can just see just how absurd that is. Even German yields now have gone positive, having spent essentially 6 to 7 years negative. And this slide here shows the real yields of government bonds and just how low they are relative to their history. Now, we would expect inflation to come down a little, but the real drivers of inflation, which are wage growth, which are rents, which follow real estate asset values, continue to show upward pressure. And in that environment, bond yields, despite having risen around about 100 basis points over the last 3 months, are still too low. And we would expect those yields to rise further. And the way you protect yourself in a rising yield environment is to have extremely low duration within the bond portfolio, and that is what we have. Duration is a bit of fund management capital market jargon. It simply measures the sensitivity of a bond price to any given change in yield. So a long 30-year bond in the US today would have a duration of about 28 years. What that means is that if yields rise by 1%, you will lose a little over 25% of your money. Short duration bonds have much lower, many factors lower sensitivity. So in a rising yield environment, that is what you need to have, and that is how we are positioned within this portfolio. Just looking at the equity positioning, this process does what it says on the tin. When equities, which will be the best performing asset within our investable universe, when they become better value, we will buy them. That is what we did back in early 2020 when COVID led to sharp market declines and equities returning to some semblance of reasonable value. Since that point, equities have been inflated by monetary money printing, monetary expansion, and have also got more bullish about the recovery from COVID, which has indeed materialized. Unfortunately, it's materialized with significant inflationary pressures coming through as well. So we took the opportunity in 2021 to reduce equity weightings further, and we have maintained this very low weighting of 20% thereafter. If equities come down further, they become better value, we will go and buy them. That's the essence of a contrarian value-driven strategy, and that is what we pursue in our process. So just a summary of how the portfolio is positioned for you. We have a little bit of cash, which obviously doesn't produce much return, but it also doesn't give you any opportunity to lose money. We have 77% in bonds, extremely low duration, no Japanese bonds, no Eurozone bonds. The exposure is to the US, to the UK, to Canada, and Australia. And we have 20% in equities, more non-US equities than US equities. So that just reflects the better value that's available in or outside the US. And as you can see from the bar charts in the top right-hand corner there, the favored area is very, very much Asia, excluding Japan. These markets are better valued. They offer greater sustainable economic growth, and it's possible in the higher quality markets of Asia, which are Singapore, Australia, Hong Kong, Taiwan, Malaysia, and Indonesia, to find very well managed companies offering sensible valuations and with clear exposure to the superior economic fundamentals that you can find in that area. Just a word on the characteristics of the portfolios of the equities we have in our portfolio. This portfolio will always have a higher yield than the market. It always has a high return on equity. But very importantly, it has a low level of debt. In the bottom right-hand corner, you'll see the debt to equity of the MSCIACWI index, 133%. A lot of companies have borrowed in this very low interest rate environment. As those fundamentals changed, you don't want to have a lot of debt, and our portfolio has a lot less debt than the market. In general, we do continue to believe the US dollar is overvalued. So within our risk parameters of 0 to 45%, we are towards the top end of exposure to non-US dollar currencies. We are hedged the Aussie dollar to bring us within that risk parameter. Again, back to process. If you have risk controls, you must observe them, and we always do. But we do believe that the US dollar on purchasing power parity is an expensive currency, and over time we'll have to give up some ground. So in summary, this is it's called a cautious fund. It's particularly cautious right now because there are lots of opportunities to lose money. And where that prevails, you've got to find somewhere to hide, and you hide in quality, and you hide in value, and you hide in low duration equities. But I think those of you who have looked at this strategy before will see that when the facts change, we will change our point of view. We will adopt greater risk within the parameters of the global cautious funds limits, and go and buy risk assets. Those I anticipate will be more equities as they get cheaper. So anyway, thank you very much for your time today. Very happy to take any questions if I haven't used up all the time.
Tony, thank you so much. We are almost out of time, but we will try and squeeze in one question. With our previous speaker, we spoke about inflationary pressures and how this would filter through to some of the emerging markets. I'd like to pose maybe a similar question to you, because you did obviously highlight in your presentation there that obviously inflation has been a very big concern. I'd like to zone in particularly into Europe, looking at that particular region. How do you think it is positioned to deal with further inflationary pressures, and given its already fragile economy?
Right, from a macro point of view, I don't think it's very well positioned at all, which is why we have so little exposure. Some of the more healthy countries like Germany have much lower levels of debt, Scandinavia, Switzerland as well. The problems lie in peripheral Southern Europe. These countries were in trouble from a debt point of view before COVID came along, and they're in a lot more trouble now, and in a rising yield and interest rate environment. It's obviously going to get very expensive if you have a huge amount of debt. And I think that's why the ECB is much less aggressive than the Fed. But, you know, let's face it, the job of a central bank is to control inflation. That's their mandate. And they are much further behind the curve than even the Fed. So we're not bullish on Europe from a macro point of view. What you can say is you can find some exceptionally high business models in Europe which are not exposed to the lack of demand, low growth, high debt of the Eurozone area, but are global leaders in industrial oligopolies, if you like. So they have pricing power in an inflation environment. They will be able to pass that on to their customers, and you know that's our job: go out and find these companies with pricing power. So Europe's not finished, but I think you have to be extremely selective to find those companies that are going to navigate these choppy waters well.
Thank you so much for that, Tony. Very much appreciated. Of course, that was Tony Cousins from Pyrford.